Imagine you are sitting at your favorite corner table at the Maxwell Food Center. You are nursing a kopi o kosong and you look over at the uncle sitting next to you. He is staring at his phone, a look of pure satisfaction on his face because he bought the Singtel shares near the 52-week low of $3.27. On paper, he is sitting on a capital gain of nearly 52%. To him, the blue chip giant of Singapore has returned to its former glory. But as the afternoon sun hits the pavement, we have to look past the green numbers on the screen. At the current price of $4.96, the dividend yield has quietly compressed to just 3.67%. This is the classic Singaporean investment paradox. We love the brand, we remember the IPO days of 1993, and we feel a sense of national pride holding the stock. But pride does not pay the utility bill, and nostalgia is not a hedge against inflation. Our inner circle of 190 elite members already received the zero-day intel on this price action. But today we are going to walk through the forensic math together to see if this recovery is a fortress or a beautifully painted facade. Welcome to the pit. I am Iggy, your guide through the Singapore market jungle, where over 6,000 of us run the forensic numbers before mainstream media catches on. In this market, the entry window on a sanctuary stock does not stay open long. By the time the free version drops, the setup has already played out and the price has already moved. The elite 190 get zero-day access to every forensic breakdown the moment it is finalized. Full 5-layer audit, hard numbers, no corporate hype, all in for $9 a month. Less than a Ya Kun set. Act on the analysis when it still matters. Now, let us get into today's numbers. The Singtel forensic audit for March 2026. Before we even touch the balance sheet, we need to address the raw reality of the numbers. At $4.96, Singtel has a market capitalization of 81.85 billion Singapore dollars. The trailing dividend yield is 3.67% based on the most recent distributions. When you look at the price to earnings ratio of 13.27 times, it might look reasonable compared to global tech giants. But we are not global tech speculators. We are forensic auditors of our own capital. We have to ask if a 3.67% yield justifies the specific risks sitting inside this company. For my own portfolio construction, I track these metrics not as reasons to cheer, but as forensic boundaries. Layer 1, the health check and solvency audit. In simple kopitiam logic, think of gearing like your HDB housing loan. If your flat is worth $1 million and you owe the bank $418,000, your gearing is 41.8%. It feels manageable as long as your salary is steady. However, our forensic rule for a fortress balance sheet requires gearing to be below 35%. Singtel is currently sitting at 41.8%. While they passed the interest coverage ratio test at 4.5 times, meaning they earn $4.50 for every $1 of interest they owe, that gearing level remains a red flag. It means the company is carrying more weight than our safety pillars allow. They have a current ratio of 1.19 times, which means they can cover their short-term liabilities, but the margin for error is getting thinner. Layer 2, the wealth check and cash flow integrity. Now we move to the wealth check, where we audit the actual cash flow. This is where we separate organic net property income from engineered numbers. We have to look at Optus in Australia. For years, Optus was the reliable cash cow that funded the Singaporean dividend. But after the structural integrity of that business shifted, the remediation costs and customer churn are still weighing on margins. Historically, Optus was a leader, but today it is fighting a brutal war for market share. For a 50-plus Singapore investor relying on Singtel for retirement income, every dollar spent fixing Australia is a dollar that does not end up in your POSB account. Then we have the issue of associate profits. Singtel owns significant stakes in regional players like Airtel in India. But here is the forensic catch: equity accounting. Imagine your son wins $10,000 in the lottery and promises to share it with you next year. You might feel $10,000 richer today, but you cannot spend that money at the wet market until he actually transfers the cash. Much of Singtel's reported profit comes from these overseas associates, but the actual cash dividends sent back to Singapore are often just a fraction of those paper gains. When you strip away the accounting and look at the actual free cash flow after capital expenditure, the picture becomes much tighter. Singtel is currently in the middle of a massive spending cycle, building out 5G networks and expanding Angsera data centers. Unlike a REIT that can sell an old building to fund a new one, a telco must constantly pour billions into infrastructure. When a company is spending this much while also trying to maintain a high dividend payout ratio of 79%, something eventually has to give. Layer 3, the yield spread and the 3.2% stress test. This leads us to the most critical part of our audit, the yield spread calculation. Note on the stress test buffer. For this audit, I apply a stress test buffer using a conservative floor of 3.2% as our working risk-free benchmark. While the current spot rate for 6-month T-bills is approximately 1.36%, I test the thesis against this higher than spot hurdle. If the math holds at 3.2%, the margin of safety at current levels is a fortress. We audit for the storm, not just the sunny day. Our forensic rule states that an asset must yield at least 150 basis points above this 3.2% floor to justify the risk. That means our required threshold for Singtel is 4.7%. At a current yield of only 3.67%, Singtel fails this test by 103 basis points. In fact, if we adjust for heavy capital expenditure, the real cash yield is significantly lower. Right now, the math says the umbrella is too small. Layer 4, peer comparison. Let us look at the price check by comparing Singtel to its peers on the Singapore Exchange. If you look at Netlink Trust, you are seeing higher yield stability. Even other local giants are offering yields north of 5.5%. Why would an investor accept 3.67% from Singtel when they could get over 5% from other local names with more stable cash flow profiles? You are essentially being paid less to take on more turnaround risk. The forensic gap, the difference between the mathematical fair value and the market price, is closing uncomfortably fast. Layer 5, wallet, impact and stance. To wrap this up, let us look at the bottom line for my own portfolio construction. I track the free cash flow margin and the Optus remediation trajectory as my primary watch signals. This is a personal forensic boundary, not a recommendation. Singtel is a great Singaporean institution, but at $4.96, the risk-reward ratio has inverted. When comparing this yield to the risk-free floor of the CPF special account at 4.0%, the current dividend yield of 3.67% no longer provides a positive spread for the risk taken. The math tells us that the yield no longer compensates for the gearing and the capital expenditure cycle. In this market, the difference between a sanctuary and a yield trap is decided by the numbers, not the name on the building. That is why we stick to the 5-layer audit. Standard forensic disclaimer. For March 2026, I am not a financial advisor. I am a forensic auditor of my own portfolio. This content is for educational and informational purposes only and is produced in alignment with the March 2026 MAS guidelines on online financial content. All data is sourced from public filings and processed through the Investing Iguana forensic lens. No part of this analysis should be construed as a recommendation to buy, sell, or hold any security. Investing in the Singapore Exchange involves significant risk. Always perform your own due diligence or consult a licensed professional before committing capital. Would you like me to run the same 5-layer audit on a banking giant like DBS or a stable play like Netlink Trust to see how their yield spreads compare against our 3.2% forensic floor?